Property investing may be simple, but it's not easy. And look, that's not a play on words. When you look at the statistics and see that most investors never get past their second property, you realise that most of those who get into real estate won't achieve the financial freedom they're looking for. While it's possible to make good money in property, it'll be more of an uphill battle in the current slow real estate markets. However, avoiding some of the classic mistakes will help keep you on the right track. Before I discuss these, I'd like to remind you that I'm doing a series of seminars around Australia, my national property market and economic updates, and if you just click on the link below this article, you're actually going to see where these will be conducted. I'd love you to come and join us, because I'll be joined by Rolf Schaefer, a student of economics and a property finance strategist, and also Ken Race, plus local area experts, and we're going to tell you some of the things to avoid, some of the things to do, and how you can take advantage of the current property markets. Okay, look, let's get back to having a look at some of the mistakes some people avoid. Some people make, I should say, so that you can avoid them. Okay, one of the big mistakes people make is they actually don't have a plan. So deciding where you want to get to with property as a property investor is more complex than just buying a property. Approaching investing without a well thought through strategy that fits in with your long-term wealth creation goals and financial goals is really just a fool's journey. You'd never take off in your car without knowing where you intend to go and how you plan to get there. As a property investor, you also need to have a map. Work out where you want to be in 5, 10, 15 years time, then construct a detailed plan how to take you there. Mistake number 2 is trying to do it all yourself. All successful property investors get a great team of people around them. I often say if you're the smartest person in your team, you're in trouble. However, you can't blindly hand over financial control to your finance broker, your accountant or solicitor. It's your responsibility to gain the knowledge about property investment and become financially smarter, what I call becoming financially fluent. This will teach you the right questions to ask your advisors. Mistake number 3 is avoid not looking at the research. See, I've met investors who've researched the purchase of their car more carefully than researching their investment property. Many buy their properties emotionally, close to where they want to live, where they want to holiday, where they want to retire, and they do it in their comfort zone. The due diligence that goes into purchasing an investment property must be much more rigorous than that. As an investor, there's only 3 good reasons to fall in love with property. If it's your investment strategy and goals, the numbers work, and it's got upside potential. Never let your emotions drive your investment decisions. Okay, that's what home buyers do, but not people trying to create wealth through real estate. The 4th big mistake is losing sight of the big picture. Sure, property is a long-term investment and the costs of buying and selling are considerable, but that doesn't mean you should just fall in the trap of not regularly reviewing your property portfolio. Once a year, sit down and have a look. Do you own the type of properties that will allow you to take advantage of the next property cycle? Remember, over the next few years, some properties will strongly outperform others. If you own secondary properties or real estate in areas that are unlikely to benefit from strong capital growth, it may be worth considering selling up and replacing your properties with the sort that will help you get the long-term financial independence you want. Just think about it. When was the last time you checked to make sure you're getting the best rents, or your mortgage is appropriate? Maybe it's time to refinance. Even if you're not going to buy another property, just to increase your equity, to buy yourself some more time by having bigger buffers. The next mistake investors make is looking for a get-rich-quick scheme. If you're like me, you get all these regular emails promising instant get-rich-quick things in property. They pander to those investors who are really, maybe not investors, but speculators looking for that one big deal. That something that's going to make them a millionaire overnight. Trust me, they do not exist. Warren Buffett wisely said, wealth is the transfer of money from the impatient to the patient. Successful investment is about patience and time. It can take 2 or 3 property cycles to build a sufficiently large asset base to allow you to fire your boss. The next mistake investors make is they look for a bargain. Sure, your money's made when you buy property, but you set yourself up for the property investment success by buying the right property, not a cheap property. Mistake number 8 is wanting to be a renovator and developer without fully understanding the implications. Now, I'm all for adding value through renovations. I'm all for doing property developments. That's where I cut my teeth in property. But you can't just buy a property, you do minimal work and sell it for a profit. Things like stamp duty and buying and selling costs and taxes eat away at your profits. On the other hand, the buy, renovate and hold strategy is a great long-term investment strategy. The ninth mistake investors make is not recognising the risks. Some investors just don't understand the risks associated with property investment and they don't manage them correctly. Strategic investors don't only buy properties, they buy time by having the right financial buffers in place. Not only to cover negative gearing, but all those ups and downs we get through the cycle. Another way smart property investors protect their assets is to buy them in the correct ownership structures, things that will allow them to legally minimise their tax and protect their assets. I've found that most wealthy property investors own nothing in their own names but control their assets through companies or trusts. The reality is that if investing in real estate were easy, everyone would be successful at it. Fortunately, many of the struggles that investors endure could be avoided by proper education, planning and due diligence. However, in the short term, there are clearly going to be some challenges in our property markets, but there's also going to be opportunities. So it's critical to learn from experienced and successful investors, from somebody who's already achieved what you want to achieve in the long term, and somebody who's retained their wealth. And that's precisely what you're going to get at our upcoming Property and Economic Market Update one-day events that I'm going to be holding around Australia currently. I won't be conducting seminars similar to this until well into next year, so please click on the link below and get the full details and join Rolf Schaefer, Ken Race, local area experts and myself as we give you some straightforward, no-nonsense practical steps and some honest answers to improve your property investments this year and into the future. Reserve your place right now, find out more and you'll see what's going on. In the meantime, I'll be sending you my regular daily blogs or my newsletter, whichever of the two you subscribe to. Catch up with you soon.